So, good afternoon, everyone. Welcome to the class. So, we in the previous class we are discussing the formulas of risk and return when we work on the calculation of determination of the value what we get from the stock market investment. So, whenever we talk about the value what we get from investing in the stock market, then possibly because stock market is more riskier than any traditional what you say risk-free instrument product. So definitely it works on the logic that more risk more return. So because it works on that logic that more risk more return, and because stock market is considerably riskier than other traditional risk-free instruments, so in that case, whenever we talk about stock market, we know that stock market are more riskier than any instrument. But gradually we need to understand that not all the instruments, not all the stocks are equally risky. Normally to measure the risk of any stock, we actually calculate the beta of the stock. So beta of the stock, if the beta of the stock is more than one, then we believe that the stock would be more than the market, while the beta of the stock is less than one, then we consider that the stock is considerably less riskier for the investment. So while talking about the beta, when we talk about beta, so beta of the stock, whenever we want to find, let the S is the return on the stock, let S is the return on the stock, and M is the return on market, and M is the return on market. So basically, when we talk about the formula of beta, the formula of beta is n summation of Sn minus summation of S into summation of M divide by n summation of M square minus summation of M whole square. So this is the formula of the beta of the stock. So if the beta of the stock is more than one, then we consider the stock to be a risky stock or aggressive stock. So those investors who are really interested to take more risk to get more return, they can choose those stocks which are having beta more than one. While those investors who don't want to go for more risk, they want some more kind of defensive kind of stocks like pharma, FMCG based company. They can probably choose those stocks which have beta less than one. Usually, the beta of the stock in the long run is always positive because stock moves more or less in the direction of the market only. So it's not like every day this is going to happen, but on a general basis, the direction of the stock more or less follows the direction of the market, because market is, after all, it is a representative of the best companies of the sectors. So market, what is market? So market is Nifty in case of National Stock Exchange. Market is BSE in case of market is Sensex in case of Bombay Stock Exchange. So Sensex is the portfolio of top 30 blue chips company, while Nifty is the portfolio of top 50 blue chips company. So blue chips company which are large capitalized, having the large capitalization. So those best 50 companies performance we see in the movement of Nifty, and top 30 performance of the best companies we see in the movement of Sensex. So after all, when we say market, market is what? Market is Nifty or Sensex, depending upon what benchmark index we want to follow. So as in normal individuals are not so efficiently enough can prepare and index which can track the Nifty or Sensex. So if we are someone who actually want to replicate Nifty, or we want to actually replicate Sensex, we don't want to use our brain. We know that the companies which are put in Nifty and Sensex, they're the best performing company, and if I simply track these best performing company, I can achieve my desired objective. So either manually and physically, I can do that homework of working on the active portfolio management. Or while if I want the same thing through passive portfolio management, then I can simply invest my funds in index funds. So if I simply put my money on index fund, so I can choose which index I want to put my money, and based upon that, what will happen automatically? My money, instead of putting on one stock, it got distributed in on all the best 50 of blue chips company, which actually are the part of Nifty, in the same proportion in which these companies are present in the Nifty. In the same proportion, my money will be allocated on these stocks. So that way, like index funds and all. So if that way, if we do investment, we can avoid the possibility of tracking errors. Tracking error possibility can be avoided, and at the same time, uh, as an investor, I get the best advantage of the minimization of unsystematic risk, and at the same time, I get a portfolio where that portfolio is the best portfolio based upon the way the market reacts at that time. So maybe in short run, maybe you can't find unexpected gain or unexpected more profit in the short run, but possibly in the long run, if we see index fund, definitely they have the potential to get good return for us in the long run, because ultimately they represent the best blue chips companies which can be tradable in the market. So that is the logic what we basically discuss. So it is very easy. It is very important that to where we need to talk about the beta of the stock. So basically, when we talk about the beta of the stock with respect to market, that basically measures the covariance between stock and market. That basically measures the covariance between stock and market. That basically measures covariance between stock and market, divide by the variance of market, divide by the variance of the market. So that gives you the formula of beta. That gives you the formula of the beta, so you can remember the beta. So basically, first of all, talking of beta, the model which first of all discussed the factor of beta was the CAPM model. So we have studied in CAPM model, we have studied in the CAPM model that the return what we get on the stock, that is equal to RF plus beta into RM minus RF. So we have studied in CAPM model where RF is the risk-free rate of return, the return what you get by doing investment on while doing investment on government products, government debt instruments like treasury bill, treasury notes, or interest rate what you get on bank FD, all that can be considered as the RF. Beta, when we are discussing about beta, we are basically talking about a scenario where we are talking about a well diversified portfolio scenario. So under a well diversified portfolio management scenario, what we are discussing here. So here, what we can do, we can plot the graph here. We can plot the graph between the covariance between stock and market. So if we plot the graph between the covariance between stock and market, so if you plot the graph between covariance between stock and market with respect to the expected return on stock, with respect to the expected return on the stock. So this is the return on stock with respect to the covariance between stock and market. Okay, so this line what we get, we call this line as SML. SML stand for security market line. Okay, and the alpha that like intercept for that is RF, and the slope of this is RM minus RF divided by the variance of the market. So all the undervalued stock lies above all the undervalued stock lies above the SML. So all the undervalued stock lies above the SML. All the undervalued stock lies above the SML, and all the overvalued stock lies below the SML. We, as per the efficient market hypothesis, what we have studied that all fairly valued stock lies on the SMA, but in reality, like very difficult to work on the calculation of fairly valued stock. So always, because of time, there's always a possibility of liquid premium or liquid discount. There's a possibility of liquid premium or liquid discount, and based upon that, what we can say, we can we can say that it's like not all the stocks will lie on the SML. They may or may not will lie on the SML. So that possibility is very difficult to work on. So after all, when we look into the stock, when we are trying to measure the return on the stock, we can use, if we are using historical data, then the average return on the stock is the sum of the returns divided by the number of return. That is called average return. That that so that is called average return. So that is the sum of return divided by the number of return, that we called as an average return. And going further, and going further, if I get a forecasted data, if I get a forecasted data of returns with respect to the probability, then my expected return would be the summation of the sum product of the probabilities which is given for different scenarios, with multiplication of that probability with the individual return under that probability. So the summation of that will give you the expected return. So it's again, so because stock market is more riskier than the normal market, so definitely, there's definitely, when we see investment of them, definitely there's element of risk. And there's always an element of uncertainty is there, and because of that element of uncertainty is there, so because of that reason also, the returns are is not guaranteed. So that is how the stock market basically works. But it's not like all stocks are equally risky. It depends upon the beta of the stock. We can primarily measure the systematic risk of the stock, because beta is the factor which measures the systematic risk on the stock. Okay, so we can keep that in our mind. So now let's try to solve this problem. Suppose this is the problem. Suppose this is the problem. So if I'm asking you what if I'm asking you what is the expected rate of return of alpha and beta? So the formula for the expected rate of return, what is the formula? The formula for the expected return. The formula for the expected return, if I'm asking you, the formula of expected return is summation of pi into r. Okay, so p probability is given to you, so you just need to multiply pi into ri for alpha. Okay, so for alpha, I need to calculate. So 0.05 into minus 2. So 0.05 into minus 2. So what value you will get? 0.05. So 0.05 into 5 twos are 10, and then 2 decimals. So you'll get minus zero point 0.1. Then zero point 0.2 into 9. So 9 twos are 18. So you'll get 0.18. Okay, 9 twos are 18. So you'll get 9 twos are 18. So 1.8 you'll get now. 9 twos are 18. So 9 twos are 18. 9 into zero point 0.2. 9 into zero point 0.2. 9 twos are 18. So you'll get 1.2. So so 12 fives are 12 into zero point 0.5 means 6. Okay, 12 into zero point 0.5 means 6. 15 into zero point 0.2 means 3. To 15 into zero point 0.2 15 twos are 30, so means 3. 15 twos are 30 means 3. 26 into 5%. 26, 10% is 2.6. And 5% would be 1.3. No? So 1.3. 1.3. So expected return of this would be how much? Expected return of this is how much? This is 1.7. 1.7 plus 1.3. 1.7 plus 1.3 is how much? 3 now. 1.7 and 1.3, that is 3. 3, 3, 6. 6 plus 6, 12. Okay, so now you got alpha. Now I'll find for beta. So pi into ri. So beta 0.05 into 3. 5 threes are 15. 5 threes are 15 and 2 decimal is there. So you'll get 0.15. Okay, so minus sign. Okay, so 5 threes are 15 and 2 decimal. Okay, 0.2 into 6. 6 into 0.2. 1.2. Then 11 into 0.5. 5.5. 14 into 0.2. 14 twos are 28. 2.8. Then 19 into 0.05. 19 fives are 95. 19 fives are 95. So 0.95. So 0.95. So 0.95 minus 0.15. That is 0.8. 0.8 plus 1.2. 2. 2. 2. 2. So this is 2. 2 plus 5.5. 7.5. 7.5 plus 3. 7.5. 7.5 plus 3. 10.5 minus 2. 10.3. So the answer for this will be 10.3. So you can just confirm this. So this is the expected return of alpha and beta. So you can just confirm this. This is the expected return of alpha and beta. So you can check this 0.95 plus 2.8 plus 5.5 plus 1.2 minus 0.15. 10.3, correct. Then before that is 1.7, 3, 3, 3, 6, 12. That is fine. So you got the expected return of alpha, you got the expected return of beta. Okay, I don't think calculation was any mistake. So 0.05 into 2. So 5 twos are 10, then 2 decimal means 0.1, then a 0.2 into 9, so 1.8, 0.5 into 6, 12 is 6, 15 into 0.2 is 3, 26 into 0.05, 26, 26 fives are, that is 130, 130 into decimal 1.3. So you got the expected rate of return of alpha and beta. So if the investor invests equally in both the script, what would be the return? So that expected return. So the expected return of alpha is 12%, and the expected return of beta, that is 10.3%. If it is if it invested equally, if in alpha and beta be invested equally, if the investment is done equally, if the investment done equally, if the investment is done equally, then the expected return, then the expected return on portfolio, if investment is done equally, then if the investment is done equally, means what? 50% of money in alpha, 50% of money in beta. So the expected return of portfolio. So weight of alpha and weight of beta means equal. That will be equal to zero point 0.5 expected return. So 0.5 12% plus 0.5 into 10.3%. is 6% plus this is 5.15%. This is 11.15. Clear everyone? So then the next part of the question, uh, if the proportion is changed to 25 and 75, so what would be the return? So so if so next part of the question is the proportion alpha you are investing 25%, beta you are investing 75%. So means what? Means what is the weight? So the weight of alpha. So 25% means how much I've done investment. If I find the weightage, what is the weight of investment of alpha? That is 0.25. I can write 0.25 as 1 by 4. And the weight of beta, so that is 0.75. 0.75 I can write as 3 by 4. Okay, and the return of alpha is 12. Return of beta is 10.3. Return on alpha, return of beta is 10.3. Beta is 10.3. So the expected return of portfolio. So the expected return of portfolio. Expected return of portfolio. That is the weight of alpha. That is 1 by 4 into return of alpha. That is 12 plus weight of beta. That is 3 by 4. The return of beta, that is 10.3. 3% plus uh, this is what this is what 1033 the 30.9 divided by 4. This is 3% plus this is 7 to 29. 29 means 7. 10. 10 means 2 is 8. 7.7725 means 10.725%. The expected return of the portfolio. Earlier it was how much? 11.15. Now it is 10.715. Check if any calculation mistake is there. So, 1,309. Okay. Then similarly, if the this another case in the third case, so if the weight of alpha is 75%, if I put the weight of alpha is 75%, 3 by 4. And if I put the weight of beta, if I put the weight of beta as 25%, means 1 by 4. Again, what is the return on portfolio? What is expected return on portfolio? You know that the individual return on alpha, if you would have put 100% of money in alpha, you would get 12% return. Okay, so you get 12% return. You put 100% of money in beta, you get 10.3% return. So this is 9%. This is the 2 28. Sorry, 4 2 8. 23. 23 means 5 23 means 5 and 30. 30 means 7 5.2.575. This is 11.575%. With this, you get the situation. So in this set of questions, we just need to calculate the expected return in all the cases. So this is the question. So the expected rate of return and the possibilities of the occurrence for the alpha and beta companies are given below. Find out the expected rate of return for alpha and beta script If the investor invested equally in both the script, what would be the return? Equally means half on alpha, half on beta. Then if the proportional is changed to 25 and 75 and 75 and 25, what would be the return? So again, the legacy. Clear everyone? Anyone have any doubt? Clear? Anyone have any doubt? Anyone, any question want to ask?